On the question of tax cuts, it is bigger than we'd expected or anticipated. If it wasn't, would you be cutting rates sooner or would you be going lower?
The tax cuts are longer than we anticipated back in March, where we roughly had a year there, and it's got several years in the pipeline. However, we did, in these forecasts, have knowledge of the overall fiscal numbers that have come out in the budget. We're not part of the government policies, but we know the overall fiscal numbers.
Not really answering the question, though. Would you be able to cut rates sooner if the tax cut wasn't bigger than?
Just run through your question again. When you say bigger,
Well,
you mean longer or higher?
Bigger and longer. you assumed, what, $1.5 billion?
That's right.
Also, it's bigger and longer. Presumably,
Well, it's particularly long.
Yes. Presumably that changes the picture in terms of
Look,
when you can
I mean,
cut
that
rates
depends
now.
on the counterfactual all the time. What would have happened with that extra money? If it had been money that government had been going to spend in, say, for example, social spending, then it's probably pretty new. If it had been money that they were going to save, then perhaps, but you can only say perhaps. You can't go much more than that because it's a lot of
Has KiwiSaver and the greater than expected uptake of that, has that sort of played into your forecast at all? I mean, do you
Not
think that-
particularly. I mean, it's in our forecast. It's not big enough to make a difference yet. There will be in some out years, but not yet.
And what about in terms of the lag that came in terms of when you raised interest rates and the lag before they had any effect? Presumably you'll see a similar lag once you start cutting, and then how are you sort of balancing that?
Well, we've certainly been looking in a general sense at what monetary policy, how monetary policy would work in a weakening economy, and if and when and if we decide to cut rates, how that would pass through into, for example, effective mortgage rates. You will notice in our forecasts that we actually continue to forecast higher effective mortgage rates. That's simply a pipeline effect of people having to renegotiate at higher spot rate or higher term rates. We could see it taking a little while to get that effective rate down. However, the signs are people are moving towards shorter mortgage borrowing periods at the minute, which makes it more flexible. In addition, they're always going to be looking up in the future, and that's one reason why the Reserve Bank of New Zealand has for a long time put out future rates to help people do that. So it could be a bit sticky downwards. We wouldn't visit a major problem.
Could you please explain why there is a lag? You might cut the official cash rate, and then there's a lag for mortgage holders before they get.
Yeah, because we don't actually set retail mortgage rates. We set a really a zone on a wholesale rate, short term, and then it depends on how the banks are funding as to what their actual rates are going to set and where they want to position themselves from a competitive point of view and a range of other things. In addition, the longer term, the move out from spot mortgage rates to term mortgage rates has meant it's taken people a while to renegotiate rates. You can have international factors and more complicated.
What makes you think that inflationary expectations won't continue increasing, given you're going to see CPI spiking to 4.7%?
Well, the short answer to that is that we think monetary policy from the Reserve Bank of New Zealand has been credible. People take it seriously. And that means that they look through shorter term features to the more medium term. Actually, you'll see inflation expectations have been creeping up, but we think they've been pretty well behaved compared to what might have happened in the past faced with these sort of very high oil price increases and now food price increases. So we think people will keep looking through those to a more medium-term focus.
Do you think that that credibility will be dented, given that this is the highest inflation rate since the implementation of the Reserve Bank Act in 1990?
I don't know, is that be quite correct.
Well, according to Dr McDermott, it is.
That's, I don't think it's quite said actually.
No, it wasn't. We had 4.7 in the end of 1990, and inflation target was already
It's more or less.
established.
It was
I don't
implemented in
know.
1990.
More or less.
yeah.
I think everybody realises that we're having the highest period of commodity prices, oil prices and food prices around the world since the 1970s. There's no way that a monetary policy in a small, open country like New Zealand can stand against that, nor should. I think people will look back in this period and say they were right to keep the medium-term focus. That's what we're having. But we don't want to disguise the fact there are very big worldwide inflation pressures, and all our trading partners are pushing up their inflation forecasts, and some of them have quite unpalatable inflation numbers, and it's a challenge for the world.